Welcome, everyone. Thank you for joining. We have a market that is again in the red, and it's not even. It's not spread across the board evenly. We have the Dow Jones down only 0.5%. It's barely even a move for the Dow Jones. These are like the J&J type of companies, the big profitable industrial companies, kind of the old-fashioned, bigger, profitable, mature companies. That's mostly the Dow Jones companies. There's some exceptions, but that mostly compiles that index. Every company in the Dow Jones, I believe, is highly profitable, high amounts of free cash flow. Then we have the S&P 500. Everybody knows about this. It's just the 500 biggest companies in the US, market cap weighted, very basic, but a powerful, very powerful index. Then we have the NASDAQ, the tech-heavy index that's been led by companies like NVIDIA and Apple and Amazon and Microsoft and Tesla, right? These type of tech companies. It's down 2%. So the companies that are more tech-oriented are down way more today than the cash flow heavy companies. And it might just seem like trading and it's all random, but I actually think that there's some logic behind this. We can make sense of it. The big thing that's happening right now is the Fed is actually meeting today and tomorrow to discuss a topic that we've heard about a lot, and that is inflation. That's the biggest thing they're going to be discussing. They say the Federal Reserve officially meets Tuesday and Wednesday for the first time since Chairman Jerome Powell said last month that the central bank needed to shift its focus towards preventing higher inflation from becoming entrenched and away from fostering a rapid rebound and hiring from the pandemic. They're shifting their priorities away from fostering a rapid rebound and now into addressing inflation. So now we have a shift in tone for the Fed. They're no longer saying our biggest priority is to bridge the pandemic and get us back out of the pandemic and get economic growth, have jobs return. That's no longer their biggest priority. Their biggest priority is inflation, addressing inflation, making sure that inflation doesn't become entrenched in the US for years to come. That's the number one priority. And that can spell trouble for investors. Because if you look at the way that the Fed encourages economic growth and the way that they address inflation, they're the polar opposite. And one of them is good for stocks, the other is bad for stocks. The way that the Fed actually encourages economic growth is good for stocks. They lower interest rates, which makes it so that companies can borrow at cheaper prices, encouraging reinvestment and growth and investment in different businesses. That's what the lower interest rates do. But then they also do what's called QE, which is a fancy term for buying lots of assets. The Fed is a huge buyer of bonds, and that adds liquidity to the stock market. Look how much they've added to their balance sheet over the past couple of years. This is QE. In combination with the lowered interest rate and the QE and the stimulus from the central government, we've seen an economic boom in stocks that we haven't seen in the past couple of years. This has all had an enormously positive impact on stock prices. Well, now the Fed's priorities have shifted. They're now addressing inflation. And the way that they address inflation is by basically doing the exact opposite of spurring economic growth. They're going to be doing tapering. Tapering is a fancy term for slowly and incrementally reducing the amount of bond buying they do. So this number right here, this chart, will slowly start to taper off. That's what the tapering is. It means that this amount will taper off over time until it will flatten. Then when it's flat and they're no longer doing any QE, the next step is to do quantitative tightening, which is actually selling assets back into the market. And just like we've seen with share dilution, the more there is of something, usually the price comes down. So this is a move in the opposite direction. The same thing that has made stock prices go crazy over the past couple of years is now being slowly reversed. We're also getting predictions from CNBC now that the Fed will halt asset purchases. That is the tapering done. Now they're no longer doing quantitative easing, and they will increase interest rates. They'll hike the rates by June of next year. That's what one survey says. Now, I think this might be a little bit aggressive. I think the Fed will let inflation run a little bit hotter. I think they'll be very reluctant to hike interest rates that soon. That's my prediction. But these are all predictions, and investors make their moves based off of predictions. As long as we're getting these type of headlines where the Fed is they're now tapering more aggressively, they're halting their asset purchases, they could be actually doing quantitative tightening in the future and raising interest rates, that's going to cause the stock market to go down. This is something that investors anticipate in the future that will further discount these type of higher risk companies. Now, with that backdrop and that context, there's a couple different options that investors have. One of them is to play the trading game. act as a trader. And that would be to kind of reposition your portfolio as you go along and try to predict the moves of the Fed and the interest rates and inflation. You take all the macroeconomic data and you try to incorporate that into your investment strategy. And investors do this all the time. I think this is good reason why investors are selling out of IGV and buying the safe haven companies, the Googles and Microsofts and Apples and Facebooks. They're moving from the risk-on companies. They'll be more hurt by raising interest rates, and they're moving towards the safe havens. That's one move that you can do. So my strategy is different. I'm not taking the trader's approach. I'm not trying to take quantitative easing or tapering and the Fed's interest rates and the central government stimulus and inflation data. And I'm not trying to take all this macroeconomic data and incorporate it into a coherent investment strategy. I think that's very difficult to do. Some people can do that. They're very good at it. They have that strategy, they have that skill, and it can work for them. I believe that there's some people that can make money doing that. My strategy is much more simple. I've done research on these companies. I think they'll be much bigger in 5 years than they are today. And I'm basically doing a buy the dip strategy, something that has worked time and time again. IGV is around 13% from its all-time highs. When it dropped 10% from its all-time highs, I did a small buy. I bought $2,000 worth. If it drops down to 20% from its all-time highs, I'll do a much bigger buy, probably $5,000. And then if it drops down 30%, I'll do a bigger buy. I don't know where the bottom is. I don't know when this will turn around. It could be in limbo for a long time, but I'm willing to be patient and buy any dips that these companies offer. Any big dips, 20% down, 30% down. If you get into correction territory, I'll be buying those dips because I think these companies, cloud computing companies in general, will be very big companies, massive companies in the future. Now moving on, I have to mention this whole Peloton debacle because it is hysterical. Here's from the New York Times, okay? So they have the big question, could Peloton sue over its And Just Like That appearance? I think And Just Like That is the name of the new series. They say the Peloton stationary bike played a pivotal role in the new HBO Max Sex and the City revival. I don't know who's watching this anymore, but they're reviving Sex and the City, which I think originally it came out in like early 2000, but they're reviving it and it's called And Just Like That. Now let's go into this. Peloton, a maker of a high-end exercise equipment, was apparently just as surprised as you were by its appearance on And Just Like That, the new HBO Max limited series that picks up the story of Sex and the City. At the end of the first episode, Mr. Big, Chris North, the on-again, off-again love interest of Carrie Bradshaw, Sarah Jessica Parker, clips into his Peloton stationary bike for his 1000th ride. Shortly after he hops off the bike, he has a heart attack and dies. This is how their product appeared in the show. He goes for a ride on a Peloton and has a heart attack and dies. After the shocking ending, we couldn't help but wonder, are companies usually in the dark about how their products will be used in movies or TV shows, as Peloton reportedly was? I already know the answer to this. They're not. Not every company just says, yeah, you can use our product at any context without our discretion whatsoever. Apple would never do this. You're never going to see an iPhone used in a way that makes Apple branding look poor. Apple's notorious for using product placement, right? This is a huge business for them. If you watch any Apple TV Plus show, you'll notice that there's product placement everywhere, and it's always in a positive light. They'll never have this happen. Apple knows, most companies, big companies, are very meticulous and careful about how they have product placement. But it looks like Peloton was left in the dark. What does a typical product placement agreement look like? And if a company is particularly upset with how its product is portrayed, does it have any legal recourse? So can Peloton sue? According to Nancy C. Prager, an intellectual property and entertainment lawyer, there are two types of product placement agreements. One in which a company pays to be featured in a show or movie, and another in which the production company procures the trademark product to be used on screen. I bet this is what they did. I bet the production company said, we want to use Peloton, and they actually sought out Peloton. Because it doesn't look like Peloton was actually going out trying to find marketing. Peloton declined to state on the record whether it was involved in any formal product placement agreement. But if a production company wants to use a trademarked product, Ms. Prager said it must get a special license to show the product and brand logos. In the episode, the Peloton logo is clearly visible on Mr. Big's bike, and the instructor video closely resembles the real Peloton course. So they got Peloton's permission. I'm guessing that Peloton was asked by them, can we use your product? And they said, sure. Free publicity, right? We don't have to pay for it. You want to use our product? Go ahead. And they had no clue of the context it was being used. They just assumed it would be in the background or be used in, in a normal episode. Not that it would be a key part of an episode where a major character in the show dies after using it. There's no way they were expecting that. Now, later on, they talk about how much this actually damaged Peloton's stock price and their brand. They say the tarnish can be evidenced by the stock price plummeting. She added, referring to the 11% drop in Peloton stock overnight after the episode aired. The stock continued to fall on Friday. So Peloton stock has been in a bit of a downtrend. It's been going down anyway, but not 11% in one day. That is a huge drop, and that is certainly related to this episode. So the lawyer here is saying, yeah, Peloton could actually sue. What they did, HBO, they tarnished Peloton's brand without having any type of specific disclosure in the way that they were going to be using it. It was a surprise to Peloton. It went against the way that they actually want to present their brand as being something that actually enables health and makes it so that you're healthier. Instead, they're making it out like Pelotons kill you. Now, of course, we know that Peloton has not sued HBO. At least there's no lawsuit yet, and I don't think they will. I think that'd be the wrong move. It would probably make Peloton even look worse in this situation. But what they did was genius. They brought in someone to save the day, who was Ryan Reynolds and his marketing company. Now, Ryan Reynolds is funny. He's a good actor. I think he's a really good actor, but he plays one kind of role. I don't think he's the best actor in the world, but he could possibly be one of the best marketers in the world. I mean, he is incredibly effective at getting people to want to view advertisements. That is a skill, getting people to seek out advertisements. And Peloton used his production company and him to create this overnight ad to salvage this situation. So let's go ahead and watch this ad together. This is Peloton's response to this debacle.
To new beginnings.
To new beginnings. You look great.
I feel great. Shall we take another ride? Life's too short not to.
And just like that, the world was reminded that regular cycling stimulates and improves your heart, lungs, and circulation, reducing your risk of cardiovascular diseases. Cycling strengthens your heart muscles, lowers resting pulse, and reduces blood fat levels. He's alive.
That is the best response to this type of debacle. And I love the fact that Ryan Reynolds adds in, he's alive to the end of this. Reminding the viewers and the investors, no, Peloton did not actually kill him. Riding bikes is actually good for you. But that's all for this episode. I hope you enjoyed. I'll catch you in the next one.